Welcome back to this deep dive. Today we are digging into the third quarter 2025 earnings call for LifeStance Health Group. That's ticker LFST. And if you follow the behavioral health space at all, this wasn't just another quarterly update. This was a big one.
It really felt like an inflection point. For a long time, the whole story around LifeStance was just scale.
Yeah.
Rapid growth.
But with huge losses attached.
Exactly. So the mission for this deep dive is really to figure out if this quarter, Q3, was just a fluke or if management has, genuinely turned the ship around financially.
That's the million-dollar question, isn't it? Is this new profitability actually sustainable? So let's start with the headline numbers that got everyone so excited.
Okay, so the top line, revenue, hit $363.8 million.
Which is solid, 16% year-over-year growth, a nice beat against what the street was expecting.
Right, so the volume is definitely still there, but the real story, like you said, it's about the margins.
Yeah, let's talk about the bottom line, because that's what really, I think, changed the narrative overnight.
It did. They achieved break-even GAAP EPS, so $0.00.
Which might not sound like a lot, but for a company that has been consistently losing money since its IPO, just getting to zero is a huge symbolic win.
A massive win.
Yeah.
And it was a full penny better than the consensus estimate, which was for a loss.
Okay, so symbolism aside, let's get to the metric management really wants you to focus on. Adjusted EBITDA.
Right, and this is where you can really see the operating leverage kick in. Adjusted EBITDA came in at $40.2 million. That's an 11.1% margin.
And this wasn't a small beat either.
No, not at all. It was about 14% higher than analyst estimates, and a 31% jump from the same quarter last year.
Wow. When you see margins growing that much faster than revenue, you know something fundamental has shifted in how they run the business. They got way more efficient.
Exactly. And that story of financial health, it gets even better when you dig into the deeper profitability metrics.
So take us there. Let's talk about the net income shift, because we're moving past the adjusted numbers now and into real, accounting profit.
So they actually posted positive net income, $1.1 million for the quarter.
It's not a huge number, but it's positive.
It's positive. And it's a huge swing from a $6.0 million loss just a year ago. And what's really fascinating is management now seems confident enough to guide for a full year of positive net income in 2026.
A full year of positive GAAP EPS. That completely changes the investment thesis for a company like this.
It really de-risks the whole thing.
So how did they do it? Let's get into the mechanics. We hear a lot about something called center margin. For listeners who aren't digging into these income statements, what is that?
Think of center margin as the gross profit of the clinics themselves, both the physical and the virtual ones. It's what's left before you factor in the big corporate overhead costs.
So it tells you how profitable the actual delivery of care is.
That's it. And it reached $116.6 million, which is about 32% of revenue.
32% is a strong number, up 16% year over year. So the basic economics of running a clinic are looking pretty good.
They are. But the real proof of their discipline is on the G&A line. General and administrative costs.
Right, the corporate overhead.
Exactly. So you had 16% revenue growth, but G&A expenses only went up by 10%. That is the literal definition of operating leverage.
So that argument they've been making for years, that all the money they were pouring into tech and infrastructure would eventually pay off, it's finally happening.
It's finally showing up in the numbers, clear as day. And this wasn't just on paper either. The cash flow story was just as important. They delivered strong, positive free cash flow, about $17.0 million for the quarter.
So what's the big takeaway from that for an investor? What does that mean?
The big takeaway is that they are now self-funding their growth. They don't need to go out and raise capital or take on more debt to expand. That dilution risk that, really hurt early investors, it's kind of off the table for now.
And I saw an efficiency metric that backed that up too. DSO, right? Days sales outstanding.
Yes, great point. That's how long it takes them to get paid by insurance companies. It dropped to 31 days.
Which is the lowest it's been since the IPO.
It is. And it just shows that their investments in the billing and collections tech are really working. It gives them huge confidence they'll be free cash flow positive for the whole year.
Okay, so we've got a healthy financial picture. Let's look at the engine behind it, the clinicians and the patients. What are the operational metrics telling us?
The volume story is still great. Visits were up 17% year over year to about 2.3 million.
And they're still adding clinicians, because that's a really tough market.
They are. The clinician base grew 11%, hitting just under 8,000 clinicians in total. But what's really exciting is they added a net 288 new clinicians this quarter.
That's a record for them, isn't it?
It's their strongest quarter to date. And in a sector where everyone is fighting for talent, being able to hire at a record pace while keeping who you have, I mean, that's a huge competitive advantage.
So it's not just about hiring more people. The CEO mentioned something about productivity gains.
Right. He called them the strongest ever productivity gains. And the number backs it up. Visits per clinician went up 5% year over year.
Okay, a 5% productivity jump is significant. How are they pulling that off? Are they just working their clinicians harder?
Well, management says the gains are durable, not just a one-time thing. They point to a few key levers. One is an incentive program for clinicians.
Okay.
The second is a new patient engagement platform. But the big one, the long-term bet, is technology, specifically AI-enabled operations.
AI, of course. Where is AI actually making a difference here?
It's really focused on cutting down on the administrative burden, the stuff clinicians dread.
The paperwork.
Paperwork, the phone scheduling, patient intake, documentation, parts of the billing cycle. The idea is simple. If you can save a clinician 20 or 30 minutes a day on admin, that's time for another patient visit. That's your 5%.
That makes perfect sense. Win the admin war, and it feeds directly into your margins. And what about retention? Keeping the clinicians they have.
They're still aiming for that mid to high 80% range. And importantly, they said their best regions are already running near 87%.
So they have a benchmark that proves it's possible.
Exactly. It makes the national goals seem a lot more credible.
Let's shift to the future then. The strategic catalysts. AI is obviously huge for internal margins, but they also announced a really interesting external partnership. Tell us about Calm Health.
Yeah, this is a very smart move. You know Calm, the meditation and wellness app?
Here, it's on everyone's phone.
It's often part of employer benefits packages. This partnership basically turns Calm into a giant, high-quality patient funnel for LifeStance.
How does that work practically?
So Calm is great for lower acuity stuff. But if a Calm user needs more serious clinical care, the app now routes them directly into LifeStances network for either virtual or in-person care.
Got it. So it's a seamless handoff. What's the real advantage there versus, just getting a referral from a doctor?
Two big things. First, it's probably a much cheaper way to acquire a patient than traditional marketing. And second, it gives them access to a younger, employer-sponsored demographic. It diversifies their patient base.
And what about M&A, mergers and acquisitions? They've got the cash now.
Nope. And I think that's another sign of discipline. Management was really clear that M&A is a secondary thing for them right now.
So no big roll-up strategy?
Not at all. They might do some small tuck-in deals to get a foothold in a new city, but the focus is organic growth and free cash flow. Wow. They're sending a signal that they're careful with their capital.
That discipline really brings us to the guidance. After a huge Q3 beat, what are they telling investors to expect for the rest of the year?
For the full year 2025, they kept the revenue guidance the same, but they definitely raised the profitability targets. Both center margin and adjusted EBITDA guidance got a nice bump.
Which confirms they expect the sufficiency to continue. But I did notice something. The Q4 EBITDA guidance, it actually implies that margins will step down a bit from Q3. Why would that be?
That's a great catch, and it's a fair point of skepticism. Management's explanation is that they're strategically pulling forward some G&A investments into Q4.
Meaning they're choosing to spend money now.
Right. They're accelerating hiring for their business development teams, making some tech upgrades, basically getting the company ready to hit the ground running hard in 2026.
So the story is, we're taking a small hit to Q4 margins on purpose to set up for a bigger 2026. Do we buy that?
I think you have to. It shows a ton of confidence. You don't sacrifice margin today unless you're very sure you can deliver strong growth tomorrow.
Speaking of 2026, what are they officially saying?
They're confident in continued mid-teens revenue growth next year. They see that coming from low double-digit volume growth and then low to mid-single-digit price increases from payers.
And the margin expansion continues.
That's the plan. They expect margin expansion to continue right on through 2026, anchored by all this new tech and efficiency.
All right. Let's get to our favorite segment. This is not financial advice, but we're going to put on our investment committee hats and pitch an outrageous but plausible trade idea.
Let's do it. So here's the thesis. The market re-rated this stock by 30% in a single day. A huge move.
Unbelievable.
But even after that massive jump, the stock is still down about 11% over the last year.
So there's still a lot of skepticism baked in. The market doesn't fully trust that this is sustainable.
Exactly. The stock is at, around $6.44. The average analyst price target is closer to $8.50. That implies there's still another 30% of upside left if they can just keep executing.
So the trade is betting that they can.
The trade is to go long LifeStance, ticker LFST, with a 12 to 18-month horizon. The bet is simple. This new management team keeps delivering the margin expansion and the free cash flow they promised. As they do, that valuation discount versus their peers will shrink.
Okay, so what are the key catalysts we need to see over the next year to know we're right?
I'm watching for three things. First, they need to decisively beat their raised Q4 guidance. That proves the operational strength is real.
Got it.
Second, we need to see real, tangible numbers on patient volume coming from that Calm partnership. Show us the funnel works.
Yeah.
And third, they need to come out early next year with specific, aggressive EBITDA margin targets for 2026.
Formalize the journey to that 15-20% long-term goal.
If they do those three things, the stock will catch up fast.
That lays it out clearly. So what's the core takeaway here for you, the listener?
I think the big takeaway is that LifeStance finally proved that its massive scale can actually translate into real earnings and cash flow.
Yeah.
This quarter shifts the narrative from, growth at any cost to a scaled, tech-enabled utility in a sector that's only growing.
It's a huge psychological shift for the company. They're now on solid financial ground.
They are. But here's the final provocative thought I'll leave you with. As great as this quarter was, the absolute operating margins are still pretty thin. The long-term success of this stock and closing that last 30% valuation gap, it all hinges on one question. Can their AI tools and their retention programs really, truly offset the biggest headwinds in healthcare?
Which are clinician shortages and wage inflation.
And relentless wage inflation. Can technology actually win the labor war for LifeStance? That is the ultimate test for 2026.
A question that really defines the future of scaled healthcare. Thanks for joining us for this deep dive. We'll catch you on the next one.